Coming up on Market to Market, California crashes headlong into Trump administration climate policy. And after a catastrophic fire, rebuilding the dream one fence post at a time. Those stories and market analysis with Ted Seifert next.
Funding for Market to Market is provided by Grinnell Mutual. You think differently about a customer when you stand in the middle of his dreams. We work to make sure you get covered right. Grinnell Mutual, a policy of working together. Information on finding an agent near you is available at grinnellmutual.com. This is the Friday, July 28 edition of Market to Market, the weekly journal of rural America.
Hello, I'm Mike Pearson. The touch of government is everywhere, from pocketbook to health insurance. However, the government's long reach has failed to stifle rural America's spirits. A healthy job market moved the Consumer Confidence Index over 121 points last month, a level not seen since July 2001. The healthy job market was not enough to offset lackluster inflation, and the Fed left interest rates alone. Wall Street gave a digital thumbs up to the choice as the three major indices set new records. Part of what drives economic engines are engines running on petroleum. However, climate scientists say the side effects of burning fossil fuels will be higher global temperatures. The thorny issue has drawn a political dividing line through the nation. President Trump put his foot down on any accord related to climate, setting the stage for a high-profile pushback. Paul Yeager has the details.
California broke ranks with President Trump's policy pullout from the Paris Climate Accord. Flanked by former Governor Arnold Schwarzenegger, Jerry Brown added to a cap-and-trade program both men have urged the rest of the world to emulate. The duo cheered the extension of one of the most ambitious programs in the U.S. to reduce fossil fuel pollution, while at the same time condemning President Trump's denial of seeing climate change as a deadly threat.
It's about the world, and California is leading that world in dealing with a principal existential threat that humanity faces. I mean, what could be a more glorious undertaking than the one that we're now embarked upon?
Brown has defied the president on many fronts, but this one may be the most visible show of resistance. California is one of the nation's biggest emitters of carbon dioxide, second only to Texas. The bill extends the reduction plan for another 10 years, and bipartisan support was needed for approval. Brown tried to find middle ground between claims of offering too many giveaways to the oil industry and declarations of raising food and energy prices. One Republican state senator said Brown wouldn't be happy until California leads the nation in wind, solar, and poverty.
And you're here witnessing one of the key milestones in turning around this carbonized world into a decarbonized, sustainable future.
The cap-and-trade legislation extends the limiting of carbon emissions and requires polluters to obtain permits to release greenhouse gases. Both governors say the plan to reduce the Golden State's carbon footprint hasn't taken the steam out of the economy of the nation's most populous state.
So we're getting out, but we will start to negotiate, and we will see if we can make a deal that's fair.
The United States withdrew from the Paris Climate Accord back in June. However, former Governor Schwarzenegger said the action didn't fully represent all views in the country.
It shows also to the rest of the world that America did not drop out of the Paris Agreement. America is fully in the Paris Agreement. There's only one man that dropped out.
On terms that are fair to
the United States joined Syria and Nicaragua as the only sovereign nations to not be a part of the agreement. Trump countered the deal was bad for the U.S. taxpayer, energy companies, and was costly. For Market to Market, I'm Paul Yeager.
Median farm income is expected to be just under the $80,000 mark this year. Much of that hard-earned cash will come from the off-farm side of the equation. Those numbers speak to the spirit of the American farmer and rancher. No matter what, the good feelings brought on by harvesting a crop or sending cattle to the market overpower any debt load. Often nothing stands in the way of bringing products to market, not even a catastrophic fire. Peter Tubbs has our cover story.
A visitor has to look closely for signs of the wildfires that rushed over the prairies in Clark County, Kansas last March. Unseasonably heavy rains have turned the Kansas prairie green, providing much-needed grass for ranchers who lost 600,000 acres of grazing ground to a fire that swept through the region over a 4-day period.
The minute it started that morning, it was all lost for the rest of us. So everything we tried to do or attempted to do during the fire, it was for naught.
Gardner was at the house of his brother Mark as the fire approached from the southwest. The brothers, along with Mark's wife, Eva, plotted the rescue of 4 horses in a nearby barn and escaped the inferno moments before it consumed their home base. Somehow the horses, and the horse barn, only yards away, survived.
By and large, everything that was confined or it was on wheat pastures, they survived. The cattle that we had out in grass pastures, they were consumed by the fire, or if somehow they made it afterwards, there was a large amount of those that needed to be destroyed. It was something that we never expected, never thought. You just really can't wrap your mind around the expanse of a 30-mile head fire.
The conditions were right for a devastating fire that day. A wet summer in 2016 had left pastures thick with grass that herds had not been able to eat. The ground was dry, the winds at 30 miles per hour, and the humidity below 5%. As a result, the fires raced over the landscape at speeds faster than cattle or humans could move. 6 people died, and more than 7,000 cattle were killed in the fires across 3 counties in Kansas and Oklahoma. Some cattle lived through the inferno, but their injuries were too severe for continued survival.
So as we looked at them, cattle were 3 categories. Those that were alive and were out of harm's way, those that were dead and already, their demise was taken care of, but our job was to come alongside of these people and say, you know, this animal needs to be euthanized. Nobody wants to make that decision.
Clark County, Kansas ranchers lost thousands of miles of fence as 3/4 of the county burned. Miles of ground were blackened. And as suddenly as the damage was inflicted, relief began to arrive.
I was headed on the country road to the highway to get to Ashland, and the very first thing I meet on the country road coming over a hill is a truck full of hay, and they're headed to the ranch. So, you know, the cavalry's already on the way, and I haven't even got out back to town.
The volume of support forced the city of Ashland to organize to manage the avalanche of goodwill.
What we did was form this task force and use technology to help organize us, and that's kind of how we operated and communicated after the fire, and to really move forward. And everybody stepped up in one big way. When asked to do something, whether it's local or whether it's rural America responding to our disaster, everybody stepped up in a big way.
Mountains of fencing supplies and donated hay arrived in Clark County over the following weeks. Clusters of hay are stockpiled in pasture corners, waiting for winter or when the grass can no longer support grazing. The fragile ground will take more than 1 season to return to full production. Ranchers will have to shift the number of acres per animal from 10-to-1 to as much as 20-to-1. The native grasses that make up the Kansas prairie, while durable, need time to regrow and return to normal productivity. The loss of these grasses resulted in the Dust Bowl of the 1930s, when drought caused the thin layer of topsoil to be lifted into the air by the ever-present wind.
Cash flow is going to be tight. I mean, it's going to get that way. There's not going to be calves to sell this fall that generally there would be. But there's equity there that you need to take a look at.
Thousands of miles of fence were lost in the fire and will limit grazing acres until they are replaced. Many of the burned fences were built by homesteaders in the 19th century using branches from area trees. Some of the fences being built today are using all-metal posts in hopes of surviving the next fire, when it comes.
A lot of these fences stood the test of time. We will have another fire. We will have another something. And if the next generation, those fences are still standing 50, 80, 90 years from now, then we've done our job right now.
Dustin Walker ranches in eastern Clark County, and while his grass acres burned, his herd was grazing on green wheat and survived. He has over 6 miles of fence to build at $10,000 per mile, but has received donations of both material and labor.
The donated supplies have been humbling and tremendous. The help has been outstanding. We wouldn't be able to do it without them, honestly. It takes a lot of time and a lot of money to try to get everything back to the way it should be. So it's been great, very humbling.
Just seemed right to come down and provide labor also. Cash and materials are great, but labor is always short because everybody has their own place at home to run. So, and I got the time to do it. So I'm here.
Ranchers also face a choice in rebuilding herds. Buy what stock they can to maintain cash flow, or take the long view and rebuild with the genetic traits that survived the fire. Gardner's family business is built around cattle genetics. They have enough breeding stock and genetic reserves to move forward. But the toughest problem area ranchers face is the mental challenge of a business plan reset.
One thing that I'm convinced of, that ranchers like a plan. And when they can't execute a plan, and when they're managing chaos, it's really challenging. Those ranchers that are going to excel and mount over this obstacle are those ones that can manage chaos the best.
There are just so many blessings. I mean, the outpouring of support. I mean, it truly, again, I wouldn't wish it upon anybody, but yet I think that's one thing that we have been, at the end of the day, been blessed.
From Market to Market, I'm Peter Tubbs.
Next, the Market to Market Report.
Weather and creeping drought made for volatile grain markets, while official reports and foreign market tariffs dodged the livestock markets. For the week, the nearby wheat contract fell 18 cents, and the nearby corn contract moved 6 cents lower. Exchange rates for the real, coupled with swinging weather forecasts, pulled the September soybean contract down 8 cents. December meal fell a whopping $13.50 per ton. In the softs, December cotton grew 38 cents per hundredweight. Over in the dairy parlor, August Class 3 milk futures gained 43 cents. The livestock sector spent the week shaking off last Friday's cattle on feed report and this Friday's increased Japanese tariffs. For the week, October cattle lost $4.95 and nearby feeders shed $6.05. The October lean hog contract declined 73 cents. In the currency markets, the U.S. dollar index dropped 57 points. Crude oil rocketed $3.94 per barrel higher. COMEX gold added $13.50 per ounce. And the Goldman Sachs Commodity Index put on 16 basis points to finish the week at 387 even. Here now to lend us his insight on these and other trends is one of our regular market analysts, Ted Seifert. Ted, welcome back.
Hey, thanks for having me, buddy.
Hey, we're glad to have you, Ted. And in case you want to go over things again, you can listen to our market analysis and Market Plus podcast anytime online at iptv.org/MTOM. Ted, let's kick it off by talking about the wheat market. Specifically, we had the North Dakota Spring Wheat Tour. What did they find?
38 and change is kind of what they're looking at.
All right.
So that's not far off of what the USDA had on the last WASDE report, just over 40.
Okay.
So I think there was a little bit of disappointment there that the numbers weren't 34 or, much lower than the USDA. Yeah. Even though it was lower, I don't think you got a big reaction out of the market or a big positive reaction out of the market because of that. We'll see what happens as we get into harvest here in the next couple of weeks.
You bet. Now, on the Chicago and KC wheat side, we continue to see weakness. Is the trade the dollar's gotten weaker? Is the trade still just digesting these massive stockpiles we have around the country?
Yeah, I mean, you look at the last WASDE report that we saw, and we had production for wheat come down as we were expecting. Mm-hmm. Ending stocks went higher. So it's simply, in both, actually, that was both for the domestic and the global balance sheets. It's really difficult to just get excited for wheat, Chicago and KC, without that extended strength happening in the Minneapolis spring wheat. So, without the spread pulling that along, it's difficult. That being said, I look at the prices that we're at, I look at the chart that we have and the support that we have underneath us. I don't know if we need to go much lower right here, right now.
Okay.
I'd like to see a little bit of a bounce here, but it's just fundamentally, it's really tough to get behind and get excited about wheat.
But you don't see us heading back to those spring numbers of 420, 425 in the Chicago contract right away anyway.
No, not right away. At least that's not my expectation for the time being. We'll see what happens when we get into the spring wheat harvest, and if that becomes very bearish, that could really kind of cause an avalanche because that spread's wound really tight. But no, I don't really think we're going to see that right away.
All right. Well, Ted, now I want to jump us into the corn market, and I want to start our conversation on old crop corn. We saw it drop another 5.5 cents this week, $3.74. Producers are still sitting on a pile of corn. What's your take on where this market's headed?
Well, we've actually seen a fair amount of producers selling in the last couple of weeks. It was 2 weeks ago we had the largest commercial short in 1 week that we had seen, which means that producers are selling because they're laying that off on the other end. But that's not just the U.S. producer. The South American producer may be doing the same. So we had to kind of clear out some of that corn. There are still a lot of us sitting on that corn, so there will be more sellers on any sort of rally here. But yeah, it's a tough, again, just like wheat, it's a tough fundamental story there for old crop corn after 3 years of record production, really.
Here's a question for you. This one comes from Randy in New Ulm, Minnesota. He's on Twitter at Schwab Randy, and we encourage all of you on social media to find us at Market to Market and send us your questions. Randy notes that here he's in south central Minnesota, there in New Ulm. He says there's lots of old crop left in storage, both on the farm and in town, besides widening basis. What should be on his radar?
I mean, keep an eye on WASDE reports. I'll say this, ethanol demand might actually end up being better than what we had originally been expecting. I think the old crop carryover is going to come down mainly because of that. So that might help things out. But really, we need to start looking at new crop. If we're going to have a problem with this new crop, then those old crop stocks become more valuable.
You bet.
So we could see a rally coming from weather issues here this year. So keep an eye on that. As far as basis is concerned, even if we get a rally in old crop, it's going to be tough to pull that basis along with it unless you get your end users really excited about, hey, I need to own now. So yeah, old crop's kind of a tough one. The best we can hope for is maybe lock in basis and then get a rally afterwards.
New crop, 388's where we traded on closed Friday on the December contract. Boy, there seems to be a lot of uncertainty about yields when we're talking to growers in the countryside. The bulk of the farmers I talk to say, hey, top end is probably gone. Either it's too dry or it's too wet. What number do you think the trade is looking at right now on new crop corn?
Trade seems to be factoring in something between a 165 and a 168, somewhere in that neighborhood. I think, even 165 might be too low. I think these prices would be too low for a 165, but there's certainly been talk of numbers getting into that area. I think it's too early for the trade to maybe factor that in, but you wonder if it could actually be lower than that. I'm currently, I don't have a yield estimate yet. I will before the August WASDE report, but I'm kind of wondering if my numbers are going to point me more towards the 163, 164 area at the moment. And that can still get worse, potentially, depending on what happens in the August weather. So, just that being said, if we were to end up at the lower 160s, I think there's really pretty good reason for corn prices to need to go higher at some point.
I need to go higher. We're going to test $4. Are we going to get a shot at least above 440 again?
Yeah, so 440 has kind of been the number that I've been looking at. I've been saying since last December, 421 was my target. We got within a few cents of that on this last time around. But given the damage that's been done, I do wonder if 440 might be that next big target. And really, I mean, if we end up with a 162, 161 national average yield, you could probably factor in something higher than that.
Okay, but we probably wouldn't get that number until January.
Well, see, that's the thing. Harvest, so we might have, and I've been saying this for a while, that we might have a late season rally here. Last year, go back to last year, we rallied based on weather concerns. The market kind of talked itself into, because we had some weather guys saying, hey, weather's going to be a problem this year. We're going to see, specific numbers on corn prices. And that never really happened. So we had to take all of that weather premium out of the market. We also had issues with South America happening at that same time. So this year we were very reluctant and have continued to be very reluctant to put that weather premium in. That might have to happen later when we start realizing, hey, yields aren't quite there. So this is a year where I was always looking at the back end as maybe being a possibly better time to be making marketing if you didn't do it back in December.
When we got that, yeah. Okay. Right. Now, you talk about weather premium coming back into the market. As we look at soybeans trading up here in November crop at 10.13 to finish the week, how much of that 10.13 is risk premium heading into the month of August?
That's a great question. You know, I can make a case for soybeans going $2 in either direction from where we're at.
Okay. Let's make the positive case first.
Well, weather.
Okay.
Let's see what August looks like. You know, the latest NOAA forecasts for August have been above normal temperatures and normal to slightly below normal precip. I'm going to argue if that's what happens, we're already behind the 8 ball in a lot of areas. That's not really going to translate into a great soybean crop, likely. I mean, we'll have to see what actually happens.
But we have a lot of short beans out there in the countryside that we could cook if these forecasts are accurate.
Absolutely right. So that's, you know, weather. Now, on the other hand, if we end up with a very good August and a good September, we can have a great bean crop still at this point. So depending on which way that goes, you can argue anything from 11.25 is kind of a big target of mine to the upside.
Okay.
But to the downside, 8.25 is a possibility too, based on the acreage that we have and if we had a really very good end of the growing season.
So how should producers be marketing? Do you want to be selling the physical, maybe if you're confident what you got, re-owning with a...
Yeah.
What do you want to be doing?
Yeah, I mean, so we've been doing a lot of that. I know that you know that that's sort of been one of our plans for the last couple of years. And so we've been doing a lot of that. We certainly want to leave the upside open in case we do get that run higher. But really, $10 and above, I really do feel like we need to be protecting downside some way, whether we want to come in and own puts. And now as we get later on in the season, they're not as expensive as they were if we were looking at buying them in January. But one way or another, we have to have a floor underneath us, whether it's with cash sales or whether it's using options or futures.
All right. Now, I want to talk about the livestock market. Live cattle had a very bearish cattle on feed report last Friday. Started the week off in an uncomfortable position, limit down on most contracts. And then we finished this week off with news that Japan was going to raise their tariff on U.S. beef from 38% to 50%. Ted, when we're looking at the demand picture, how important is that Japan news realistically?
Okay, so, but first of all, when you say an uncomfortable position, are you talking about like the backseat of a Yaris? But as far as the demand from Japan, that is not a huge deal. It's certainly not good news at a time where we kind of need good news, all right? So let's look at the supply side for a second, right? The cattle on feed report, placements at 116%. Wow, we are adding animals to the mix. We already have a lot of animals to the mix. Yes, we're 10 pounds under weights we were at this time last year, and this last week was the first week in a little while that we saw weights creep back ever so slightly. But we've got the animals, the weights are still hanging in there, and so that supply is growing. We're almost 20% production higher than where we were this time last year.
Yeah.
So without that increased demand, it's very difficult to make a bullish case for cattle here. Can we get more demand out of the China deal? Yes, over a long period of time that's possible. In the short run, it's not going to be enough. Okay. Demand with Japan is going to be an issue. So all things considered, I have a hard time seeing cattle stay up here at these prices. I'm very worried about what the chart looks like right now. We are challenging some key support in both live cattle and feeder cattle, and I think there's some downside potential.
So at this point, have we broken through that support level quite yet? Should we get in some hedges on right now for the first part of next week?
We have a couple layers of support. Okay. We've broken through a few of the key ones. There's a little bit left below us, but early next week, I think we're gonna see some fireworks.
And then we're looking at 96 and change, that previous low.
Quite likely.
All right. Now, feeder cattle, obviously, if that's the sentiment for live cattle, I'm guessing you don't have much of a bullish portrait on the feeder cattle market.
No, it's hard for me to be terribly bullish feeders. I'm a little less bearish feeders right now than I am, but longer term, it's still, I think, a fairly bearish story for feeders, especially if we get something going in the cord market at some point.
Right. But given the fact that we saw 116% placements, we did pull a lot of those feeders out of pasture very, very early. Right. Are we going to be maybe fourth quarter of this year crimped for supply on the feeder cattle market?
And that's why I'm not quite as bearish in feeders as I am for live cattle right now. However, if live cattle prices are coming down pretty dramatically, is there really going to be a push for that? So, yeah, I don't know. I'm bearish the cattle complex as a whole, but live cattle is the one that I'm more worried about at the moment.
Now, I want to talk to you about the lean hog market. We've got a huge spread in the lean hog market. Of course, we're anticipating fourth quarter supplies to be very strong. We've built a lot of barns. We're adding new production facilities. Given that nearbys are still around 80 and 82 bucks and change, boy, that's a lot of spread between front month and October. We're looking at almost $20.
Yeah.
Who's going to meet who?
Right.
We're going to drag those deferreds up a little bit if demand stays strong?
If demand stays strong, yes. But do we see demand stay strong? I mean, as you're saying, we have a lot of new facilities go online. So we've needed to fill those facilities. So we've got demand for the animals, and demand for cutouts has been fairly good as well. So we've needed that front end strength. But the deferred months, look at quarterly hogs and pigs report, we're at near record supplies, or record supplies at pretty much every position. So that makes it very difficult to say that longer term we need to see higher prices, and that spread has really stretched like a rubber band. Now, I'm wondering if we did get a bigger drop in the front month hogs, if that would actually support the deferred months a little bit, just as we see it unwinding that spread, because that spread there's massive positions in that spread. It may or may not happen that way, but it's been very difficult for producers to look at those deferred months and say, hey, here's where I need to be pricing out, and here's where I need to be protecting downside. Even though, fundamentally speaking, I think we have good reason to be doing that. So it's been a bit of a challenge. There's ways to kind of work through that, but yeah, I don't know. I think the front's going to come down to meet the back at some point.
Front will come down to meet the back. Ted Seifert, thank you so much for taking the time to be with us.
Always a pleasure, Mike. Anytime.
That wraps up the broadcast portion of Market to Market. However, Ted and I will keep the conversation going, including answering more of your questions during Market Plus, which is available in podcast and video form on our website. While you're there, follow the links to our Twitter feed. Tweet us your questions via @MarketToMarket, and we'll get you the answers during our market analysis or plus segments. Join us again next week when we look at the persistent drought creeping across the nation. So until then, thanks for watching. I'm Mike Pearson. Have a great week.
Market to Market is a production of Iowa Public Television, which is solely responsible for its content. Funding for Market to Market is provided by Grinnell Mutual. You think differently about a customer when you stand in the middle of his dreams. We work to make sure you get covered right. Grinnell Mutual, a policy of working together. Information on finding an agent near you is available at grinnellmutual.com.